Introduction: the hidden power of routine in trading. Have you ever wondered why two traders can look at the exact same chart, trade the same market, even use the same strategy, and yet one consistently wins while the other consistently loses? It's not luck. It's not some secret indicator. It's not even about having more knowledge or better software. The truth is, what separates a successful trader from a struggling one often comes down to something far less glamorous but infinitely more powerful: routine. Routines are the invisible architecture of success. They are the silent forces that shape decisions, sharpen focus, and build consistency. While the world is distracted chasing quick wins, the successful trader quietly follows a structured rhythm every single day. And over time, that rhythm creates results that look almost magical to outsiders. But let's be clear, there is nothing magical about it. There's just discipline. Why routines matter in trading? Trading is a game of uncertainty. No one, and I mean no one, knows what the market will do next. Not even the most experienced professional, not the wealthiest hedge fund, not the brightest computer algorithm. So if the market itself is uncertain, how do you find stability? You create it through your daily routine. Think about it like this. Imagine you're a pilot. Every time before you fly, you go through a pre-flight checklist. It doesn't matter if you've flown 100 times or 1,000 times. You still check the fuel, the wings, the navigation system. Why? Because when you're in the air at 30,000 feet, small mistakes can kill you. Trading is the same. The market is like the sky, endless, unpredictable, and sometimes dangerous. And your routine is your checklist. It keeps you safe. It grounds you. It ensures you're not flying blind or letting emotions take the wheel. Without a routine, you're gambling. With a routine, you're trading. The difference between successful versus struggling traders. Now let's paint two pictures. The struggling trader wakes up late. They roll out of bed, maybe check their phone, and rush to open the charts. They feel a jolt of adrenaline as the candles move, prices flash, and news headlines pop up. They jump into a trade without much thought, chasing what looks exciting. Sometimes it works. More often it doesn't. By midday, they're either euphoric because they got lucky or frustrated, anxious, and ready to make back what they lost. By evening, they're drained. They replay mistakes in their head. They swear tomorrow will be different. But when tomorrow comes, the cycle repeats. Now let's look at the successful trader. They wake up early, before the market opens. Their morning is calm, intentional. Maybe they exercise. Maybe they journal. They review the news, check their charts, and mark important levels. They know exactly what setups they're looking for today. And just as importantly, they know what trades they will not take. When the market opens, they are prepared. They wait. They watch. They act only when the opportunity matches their plan. If they win, great. If they lose, that's fine too. It was within their risk management. At the end of the day, they review their trades, jot down lessons, and shut down their screens with peace of mind. Do you see the difference? The first trader is reactive, chaotic, and emotional. The second trader is proactive, structured, and disciplined. Both traders may have access to the same tools, the same information, even the same strategies. But one drowns in randomness, while the other rides the waves with control. The difference is not knowledge. The difference is routine, the hidden power of discipline. Over strategy. Here's a hard truth that many traders don't want to hear. Strategy is overrated. Yes, you need a system that works. Yes, you need a method to enter and exit trades. But the strategy is only 20% of the game. The other 80% is mindset, discipline, and consistency. Think about casinos. They don't need to win every hand of poker or every spin of the roulette wheel. They don't care if one gambler gets lucky tonight. Because over time, their edge, their small statistical advantage, always plays out. Now imagine if the casino owner suddenly got emotional. Imagine if they shut down the casino every time they had a losing night. Imagine if they changed the rules of blackjack out of fear. They go bankrupt. But they don't. They stick to their system day after day, night after night, because they understand the power of consistency. So, traders are no different. Your edge doesn't come from hitting one jackpot trade. Your edge comes from following your plan over and over again. And the only way to do that is through discipline. And where does discipline live? In your daily routine. A glimpse ahead. In this book, I'm going to walk you through the daily habits, checklists, and rituals that separate amateurs from professionals. You'll see exactly how successful traders start their mornings, how they prepare before the market opens, how they manage themselves during the trading day, and how they wrap up with clarity and calm. By the end, you won't just have a trading plan. You'll have a life plan for trading. Because here's the truth. Trading success is not built in a single day. It's built in the routine of many days, day after day, week after week, month after month. This book is about helping you build that routine. So whether you're a beginner just starting out or someone who's been in the markets for years but feels stuck in chaos, this is your roadmap to consistency. Closing words of the introduction. I want you to keep one thought in mind as we move forward. Success in trading is rarely about the trade you make. It's about the person you become. And who you become is shaped every single day by your routine. So let's dive in. Let's build a structure that will allow you not just to survive in the markets, but to thrive in them. Chapter 1. The Trader's Mindset. If trading were just about finding the right strategy, everyone would be rich. Think about it. You can find thousands of strategies on YouTube, in trading forums, or even from books written decades ago. There are strategies based on moving averages, Fibonacci retracements, candlestick patterns, supply and demand zones, and more. Some of them work well, at least for a while. So why aren't more traders successful? The answer is simple. It's not the strategy that determines your success. It's the person using it. Psychology. First, why mindset beats strategy. Imagine two traders with the exact same system. Trader A follows it with discipline. Trader B follows it when they feel confident, but ignores it when they're scared or greedy. Who do you think will come out on top? Trader A wins every time. Because trading is not just a numbers game, it's a mind game. Markets are designed to test your emotions. When the price shoots up, greed whispers, don't miss out. When the price falls, fear screams, get out before you lose everything. And when nothing moves for hours, impatience taps you on the shoulder. Just take a trade already. A weak mindset crumbles under these voices. A strong mindset stays calm, sticks to the plan, and plays the long game. In fact, research shows that most traders don't fail because of bad systems. They fail because they can't manage themselves. They move stops, chase setups, or risk too much. That's not a strategy problem. That's a mindset problem. So if you truly want to succeed in trading, you have to treat mindset as your foundation. Strategies will come and go, markets will change, but the trader who has mastered their psychology will always find a way to win. Morning attitude. Setting the tone for the day. Your trading day doesn't begin when the market opens. It begins the moment you wake up. Think about mornings where you rushed out of bed, still half asleep, maybe skipped breakfast, and then jumped straight into trading. What happened? Most likely you made sloppy decisions. You felt scattered. You reacted to every tick on the chart. Now compare that to a morning where you took your time. You woke up early. Maybe you stretched or exercised. Maybe you read the news calmly, wrote down your plan, and visualized what kind of trader you wanted to be today. How different was your trading then? Here's the truth. Your first decisions in the morning set the tone for the rest of your day. Professional traders treat the morning as sacred. It's their time to prepare their body, their mind, and their focus. Some meditate, some review journal notes. Some simply sit in silence with a cup of coffee, clearing their head before the chaos begins. The point is not what exact activity you do. The point is intentionality. You're telling your brain, I'm not here to gamble. I'm here to work. I'm here to trade like a professional. When you start the morning with discipline, you carry that discipline into every trade you take. Common mental traps in trading. Let's get real for a moment. Every trader, no matter how experienced, faces mental traps. Even billion-dollar hedge fund managers feel fear, greed, and impatience. The difference is that successful traders recognize these traps and manage them. Struggling traders let these traps control them. Let's break them down one by one. Fear. Fear is the oldest emotion in the trading book. It shows up when you hesitate to enter a trade because you're afraid of losing, or when you cut a winning trade too early because you're scared it might turn against you. Fear whispers, play it safe, don't take risks. But here's the problem. Trading requires risk. Without risk, there is no reward. If you let fear dominate, you'll never take the trades your system tells you to take. And if you can't follow your system, you don't have an edge. The solution to fear isn't eliminating it. That's impossible. The solution is to control it with rules. Position sizing, stop losses, and a predefined plan are your weapons against fear. Is greed. Greed is the flip side of fear. So it shows up when you move your profit target higher and higher because you want more, or when you double down on a trade that's already in profit, ignoring your risk rules. Greed shouts, one more trade, just a little more profit. But greed is dangerous. It tricks you into breaking your rules. And the moment you break your rules, your edge disappears. The best traders fight greed with discipline. They take profits where they plan to. They don't chase extra gains. They remember, it's not about winning big today. It's about surviving tomorrow. Impatience. Impatience is perhaps the most subtle trap. You've been waiting for hours. The market is slow. Nothing is setting up. You get bored. So you convince yourself, this looks good enough, and you enter a trade that wasn't part of your plan. Impatience doesn't feel dangerous in the moment, but it's one of the fastest ways to drain your account. Trading is like fishing. You can't force the fish to bite. All you can do is cast your line, wait, and follow your process. Professionals know this. Amateurs don't. That's why amateurs overtrade, while professionals often trade less but make more. The mindset shift. So here's the big mindset shift. You are not in the business of predicting the market. You are in the business of managing yourself while the market does what it wants. Once you understand that, trading becomes less stressful. You stop trying to control the uncontrollable. You focus instead on what you can control: your preparation, your routine, your risk, and your mindset. Every morning, remind yourself, I don't need to control the market. I only need to control me. That one belief can save you from countless mistakes. Closing thoughts for Chapter 1. If you take nothing else from this chapter, take this. Mindset is the foundation. Without it, no strategy will save you. With it, almost any reasonable strategy can work. Fear, greed, and impatience will always exist, but your routine, your discipline, will decide whether those emotions run your trading or whether you run your trading. So as you move forward, start small. Tomorrow morning, don't just open your charts and dive in. Take a breath, set an intention, prepare your mind. Because the trader you are at 9 a.m. determines the results you see by 9 p.m. And in the end, the market doesn't reward the smartest trader. It rewards the most disciplined one. Chapter 2. Pre-market routine. If the market is a battlefield, then your pre-market routine is your armor. It's what prepares you before you step onto the field. And let me tell you, going into the markets without preparation is like running into war without a helmet. You don't stand a chance. Every successful trader I've ever studied, from hedge fund managers to disciplined retail traders, has one thing in common. They follow a pre-market routine. They don't just sit down and wing it. They prepare. And it's that preparation that makes all the difference. Let's walk through what this looks like in practice. Waking up early, preparing your mind. Your trading day begins long before the opening bell. The first choice you make is when you wake up. Now, this doesn't mean you have to wake up at 4 a.m. like some motivational guru claims. But you do need to wake up with enough time to get grounded mentally, emotionally, and physically before the market begins moving. If you wake up late, scramble to your desk, and open your charts with sleepy eyes, you're already behind. You're entering the market reactive, not proactive. So wake up early enough that you feel calm and unhurried. Give yourself space. Maybe that means an extra hour, maybe 2. Here's what many professional traders do in those early hours. Some exercise. Even a 20-minute walk clears the fog and sharpens focus. Some meditate, just sitting in silence to calm the storm inside before facing the storm outside. Others journal, dumping thoughts onto paper so they don't cloud their judgment later. And some read news, books, or even inspirational passages that remind them of their bigger goals. The activity isn't as important as the effect. The goal is to prepare your mind for focus. You want to walk into the market already grounded, not looking for the market to ground you. Daily review. News, economic calendar, and overnight events. Once your mind is ready, it's time to prepare your eyes and brain. The market doesn't exist in isolation. Prices move for a reason. Sometimes it's technical, sometimes it's sentiment, and often it's because of news. Every successful trader reviews 3 key things before trading. 1. The news. What's happening in the world? Are there earnings reports today? Did a central bank announce an interest rate decision? Did a geopolitical event shake investor confidence overnight? Even if you're a purely technical trader, ignoring the news is dangerous, because news can trigger volatility that no chart pattern could predict. 2. The economic calendar. This is like your map for the day. Economic calendars list scheduled announcements like jobs reports, inflation data, or GDP numbers that can move the markets. Think of them as earthquakes waiting to happen. You don't want to be caught building a sandcastle when the ground is about to shake. For example, if the Federal Reserve is speaking at 2 p.m., you may want to avoid opening new trades around that time. Knowing the schedule saves you from surprise. 3. Overnight events. If you're trading U.S. markets, what happened in Asia or Europe while you were asleep? If you're trading Forex, what did the London session do before New York opened? Overnight moves often set the tone for the day ahead. By reviewing these 3, news, calendar, and overnight events, you step into the market with awareness. You're not caught off guard. You're anticipating, not reacting. Journaling goals for the day. Now let's talk about journaling. Most people think of a trading journal as something you write in after the day is over. And yes, that's important. But equally important is journaling before the day begins. Here's why. When you write down your goals for the day, you anchor your mind. You set an intention, and that intention becomes a filter for every decision you make. Your journal entry doesn't have to be long. In fact, the shorter and clearer, the better. It might look like this. I will only take trades that meet my setup rules. I will not risk more than 1% of my account on any trade. I will stop trading after 3 trades, win or lose. I will review every trade immediately after I close it. See how simple that is? Just a few sentences. But those sentences act like guardrails. They protect you when emotions run high. And here's the magic. When you write down your goals before the market opens, you're not just writing them. You're programming them into your subconscious. Your brain remembers them when temptation shows up later. Visualization affirmations for discipline. This might sound a little unusual at first, but stay with me, because this is a secret weapon most amateur traders ignore. Visualization. Top athletes use it. Olympic runners don't just practice running. They sit quietly and see themselves running the race, crossing the finish line, winning the medal. By the time the real race begins, they've already lived it in their mind hundreds of times. You can do the same as a trader. Before the market opens, close your eyes for 2 minutes and visualize your trading day. See yourself calmly sitting at your desk. See yourself waiting patiently for your setup. See yourself entering the trade with confidence and following your plan no matter what happens. See yourself accepting both wins and losses with calm professionalism. The more vividly you visualize, the more naturally you'll act that way when the real moment comes. Now let's add affirmations. Affirmations are short, powerful statements you repeat to reinforce discipline. For example, I am a disciplined trader. I follow my rules, not my emotions. My job is to manage risk, not chase profits. Each trade is just one of thousands I will take in my career. Say them out loud or quietly to yourself. It may feel strange at first, but repetition builds belief, and belief shapes behavior. Remember, your mind is the most important tool you bring to the market. Visualization and affirmations sharpen that tool, bringing it all together. So let's put the pieces of your pre-market routine into one flow. Wake up early. Give yourself time to prepare your mind and body. Clear your head. Exercise, meditate, journal, whatever grounds you. Review the world. Check news, the economic calendar, and overnight market action. Journal your goals. Write clear intentions for today's trading behavior. Visualize and affirm. See yourself trading with discipline, and remind yourself who you are becoming. By the time you're done, you're not just ready, you're powerful. You're stepping into the market with awareness, focus, and discipline. Closing thoughts for Chapter 2. Most traders treat the pre-market as an afterthought. They think the real game begins when the candles start moving. But the truth is, the game is won or lost before the market opens. Your pre-market routine is where you build your edge. It's where you sharpen your sword before the battle. It's where you prepare your mind to stay strong when emotions start to scream. So don't skip it, don't rush it, make it sacred. Because the trader who wins the morning usually wins the day. Chapter 3. Technical Market Preparation. Preparation is everything. Think of a trader like a surgeon. Would you trust a surgeon who walked into the operating room without reviewing the scans, without sterilizing their tools, without a plan for the procedure? Of course not. So why would you ever trust yourself to trade without proper preparation? Too many traders skip this step. They roll out of bed, glance at a chart, and dive straight into the first setup that looks good enough. And then they wonder why their results are inconsistent. But successful traders know better. They spend just as much time preparing as they do executing, sometimes even more. In this chapter, we'll walk through 4 key parts of your technical and market preparation, or scanning charts and setups. Identifying key support and resistance zones, planning your risk, stop loss and position sizing, into building your daily trade plan, and scanning charts and setups. Every trader has their own favorite setups. Some look for breakouts, others for pullbacks, reversals, or continuation patterns. The specific setup doesn't matter as much as your consistency in looking for it. When you scan charts, you're not hunting for anything that looks good. You're filtering for your setups, the patterns that match your trading strategy. Here's where most beginners go wrong. They open too many charts, get overwhelmed, and start seeing opportunities everywhere. But trading isn't about finding trades. It's about finding the right trades. Think of it like fishing. If you know you're after salmon, you don't throw your net randomly in the ocean. You go to the river where salmon run. You wait patiently for them to show up. The same with charts. Pick your markets. Don't trade everything. Focus on your setups. Don't invent trades out of boredom. Let the market come to you. A professional trader's scan is calm, systematic, and unemotional. They flip through their charts like a pilot checking instruments, simply marking what's worth watching today. Identifying key support and resistance zones. Once you've found potential setups, the next step is to map out the battlefield, support and resistance. Support is where buyers are likely to step in. Resistance is where sellers are likely to push back. These zones act like magnets and barriers. Prices often pause, bounce, or reverse around them. Imagine you're driving through a city. The green lights let you pass freely. The red lights make you stop. And the yellow lights warn you to slow down. Support and resistance zones are the traffic lights of trading. If you ignore them, you'll crash. Successful traders mark these levels before they even take a trade. They know in advance where price is likely to stall, where their stop loss must go to stay safe, where realistic profit targets can be set. A common mistake is drawing too many lines, cluttering your chart until it looks like a spider web. Keep it simple. Identify the major zones on higher timeframes, then refine on lower timeframes. This clarity helps you avoid emotional reactions. When the market hits your level, you already know what to do. No panic, no guesswork, just execution. ASO, risk management planning, stop loss position sizing. Now we come to the part that makes or breaks traders, risk management. Here's a sobering truth. You can be wrong more than half the time and still make money if you manage risk. And you can be right most of the time and still lose money if you don't. Risk management has two parts, where you place your stop loss and how big your position size is. Enter 1. Stop loss placement. Your stop loss is not where you hope the market won't go. It's where your trade idea is proven wrong. That's an important distinction. For example, if you're buying near support, your stop loss should go below that support. If price breaks through, your setup has failed. That's the market telling you you're wrong. Respect it. Too many traders place stops too tight because they don't want to lose much. Ironically, that usually guarantees they lose more because they get stopped out unnecessarily. Others place stops too wide, turning a small loss into a disaster. The key is balance. Wide enough to let the trade breathe, but tight enough to protect your capital. 2. Position sizing. Once you know where your stop goes, you calculate how big your trade should be. Here's the golden rule. Never risk more than a small percentage of your account on a single trade. Many professionals risk just 1% or less. So if you have a $10,000 account and you're willing to risk 1%, that's $100. If your stop loss is 50 cents away from your entry price, your position size is 200 shares. See how simple that math is? It's not about how big the trade looks. It's about how small the risk is. This is how traders survive losing streaks, because losing is inevitable. But with controlled risk, no single trade can ever knock you out of the game. Creating a daily trade plan. Finally, the most important step, putting it all together into a daily plan. A daily trade plan is your roadmap. It tells you exactly what to look for, where you'll take action, and when you'll stand aside. Without it, you're just wandering through the markets, reacting to every flicker of price. Your daily plan should include a markets of focus. Which instruments will you trade today? For example, S&P 500, reassess into Apple stock. Key levels. Where are the important support and resistance zones? News events. Are there scheduled announcements that might affect your trades? Trade ideas. Specific setups you're watching, with entry, stop, and target levels noted in advance. Rules for the day. For example, no more than 3 trades or stop trading after 2 losses. By writing this plan, you're locking in discipline. You're turning a chaotic day into a structured one. And when emotions rise, as they always do, you have a document to anchor you. One of the biggest benefits of a daily plan is that it reduces decision fatigue. You don't waste mental energy figuring things out on the fly. You already know what you're waiting for. You already know where you'll act. That clarity is priceless. Closing thoughts for Chapter 3. Most traders fail not because they can't analyze a chart, but because they don't prepare properly. They let the market dictate their actions instead of dictating their own. Preparation is the edge. It's what allows you to face the market with confidence, knowing you've done the work before the opening bell even rings. So tomorrow morning, don't just open your platform and hope for the best. Scan your charts, mark your levels, plan your risk, write your trade plan. Because when preparation meets opportunity, that's when consistency is born. And consistency in the end is the real secret of every successful trader. Chapter 4, Execution Routine. You've prepared. You've woken up early, reviewed the news, scanned your charts, mapped your levels, and built a daily plan. Now comes the most dangerous part, execution. Why dangerous? Because this is where preparation meets reality. This is where your discipline is tested. This is where the market whispers, forget the plan, just trade. And most traders do. But not you, not anymore. In this chapter, we'll explore how to execute trades like a professional, entering trades with discipline, sticking to rules, not emotions, avoiding the trap of overtrading, using breaks and pauses to your advantage, entering trades with discipline. Imagine you're a sniper. A sniper doesn't fire at every moving target. They wait, they hold their breath, they line up the shot. Hours may pass before they pull the trigger, but when they do, it's deliberate. Trading is no different. No, when it's time to enter a trade, you don't jump in just because the market looks exciting. You don't chase a candle that's already flown halfway across the screen. You wait for your setup, you check your levels, you confirm your plan, and then, and only then, you enter. A disciplined entry has 3 elements. Plan setup. It matches one of your predefined strategies. Defined risk. You know your stop loss before you enter. Controlled size. Your position size follows your risk rules, not your emotions. If those three aren't present, you don't take the trade. Period. One way to strengthen your discipline is to use a checklist before every entry. For example, is this my setup? Is my stop loss defined? Is my position size correct? Am I trading because of my plan or because of fear or greed? If you can't answer confidently, you don't enter. That simple habit can save you thousands of dollars and years of frustration. Sticking to rules, not emotions. Here's the brutal truth. Once you're in a trade, your emotions will do everything they can to sabotage you. Fear tells you to cut winners short. Greed tempts you to let losers run. Impatience pushes you to adjust your plan mid-trade. But professionals know that the market is unpredictable in the short term. What saves them is not their ability to predict, but their ability to stick to their rules. Your rules are like guardrails on a mountain road. Without them, every curve could send you over the edge. With them, you stay safe, even when the ride feels scary. And here's the thing, sticking to rules isn't glamorous. It often feels boring. You may sit through hours of sideways action, waiting. You may take a trade, get stopped out, and have to walk away. You may watch price barely miss your profit target before reversing. But that's trading. It's not about being comfortable. It's about being consistent. Every time you follow your rules, even on a losing trade, you've won because you've strengthened the muscle of discipline. And that muscle is what will make you profitable in the long run. Avoiding overtrading. Now let's talk about one of the deadliest habits in trading, overtrading. Overtrading happens when you take too many trades, usually out of boredom, frustration, or greed. You feel the need to always be in the market. You think one more trade will fix it. But here's the truth. The market doesn't pay you for effort. It doesn't reward you for how many times you click the button. It only rewards you for quality. Think about a professional poker player. They don't play every hand. They fold more often than they bet. Why? Because they know patience is part of the edge. Traders must think the same way. Sometimes the best trade you can take is no trade at all. So how do you avoid overtrading? Set a trade limit. For example, no more than 3 trades per day. Take breaks after losses. If you lose 2 trades in a row, step away for an hour. Remind yourself, this is a marathon, not a sprint. You don't have to make money every minute to be successful. Overtrading is usually a sign of emotional trading. If you catch yourself wanting to trade just to do something, stop. Close your platform. Take a walk. Come back later. Taking breaks, the power of stepping away. Here's something few traders talk about. Sometimes the best way to improve your execution is to stop executing. Breaks are powerful. They reset your mind. They cool your emotions. They give you space to see clearly again. Imagine sitting at your desk for hours, watching every tick, every candle. Your brain gets tired. Your emotions get louder. You start seeing setups that aren't really there. That's when mistakes happen. But if you step away, take a walk, stretch, breathe, you reset. When you return, you see the chart with fresh eyes. You're calmer. You're sharper. Professional traders schedule breaks. Some step away every hour. Others take lunch and don't look at the screen. They know trading is not about staring the longest. It's about acting the smartest. So make breaks part of your execution routine. Set timers to remind yourself to stand up and move. Step away after a big win or a big loss. Use breaks to reflect. Am I still following my plan? It may feel counterintuitive, but walking away often makes you more money than staying glued to the screen. Closing thoughts for Chapter 4. Execution is where traders are made or broken. You can prepare perfectly, but if you can't execute with discipline, none of it matters. So remember, enter only when your plan says so. Stick to your rules, not your emotions. Avoid overtrading. It's a silent account killer. Step away when needed. Breaks are not weakness. They are strength. Every trade you take is a test, not of the market, but of you. And every time you pass that test by following your plan, you grow stronger. Trading is not about catching every move. It's about catching the right moves with the right mindset. And when you execute with discipline, you're no longer just trading. You're trading like a professional. Chapter 5. Midday Reset. Trading can feel like war. The charts move fast, emotions run high, and your brain is constantly processing information. If you're not careful, by noon you're mentally exhausted, even if your body is just sitting in a chair. That's why the best traders know the value of the midday reset. The midday reset is not about laziness. It's not about being soft. It's about rest, recharge, and reassess. So you finish the trading day as sharp as you started. Let's break it down step by step. Why professional traders rest and recharge. How lunch, meditation, or light exercise can reset your brain. The power of reviewing morning trades and adjusting the plan. Why professional traders rest and recharge. Here's something surprising. The most successful traders don't trade all day. Many of them, especially day traders, are done within the first few hours of the market open. They focus on the high volume, high opportunity hours, then step away. Why? Because after a few hours of decision-making, your brain is fatigued. Scientists call it decision fatigue. Every choice you make, whether to enter, exit, size up, or wait, uses up mental energy. By the time you've made a dozen trading decisions, your brain wants shortcuts, and shortcuts in trading usually mean emotional decisions. That's why professionals value rest. They know that by noon, their judgment isn't as sharp. So instead of forcing trades, they recharge. Think of it like a boxer between rounds. No fighter goes 12 rounds without rest. They breathe, drink water, and reset their strategy. If world-class athletes need recovery to perform, why should traders be any different? Lunch, meditation, light exercise. Now let's get practical. How do you actually reset in the middle of a trading day? First, lunch. Sounds obvious, but many traders skip it. They sit glued to the screen, eating chips or drinking coffee, jittery and tired. But your body fuels your brain. A balanced meal, not heavy junk that makes you sleepy, but real food, can keep your energy stable. Second, meditation. Just 5 minutes of closing your eyes, breathing deeply, and letting your thoughts settle can work wonders. You don't have to be a monk. Just breathe in, breathe out, and let your body relax. Think of it as rebooting your mind software. Third, light exercise. A short walk, a few stretches. Even standing up and moving your body breaks the cycle of staring at the screen. Blood flows, tension releases. Your posture resets. These small habits are like pressing the refresh button on your trading brain. They remind you the market will always be there. You don't need to burn yourself out trying to control every tick. Reviewing morning trades. Once you've recharged, the second part of the reset begins. Review. The morning session is done. Maybe you had a winning trade. Maybe you took a loss. Either way, now is the time to reflect. Ask yourself, did I follow my plan? Were my entries disciplined? Did I stick to my risk rules? What emotions came up, and how did I handle them? This is not about beating yourself up. It's about clarity. Traders who skip this step often repeat the same mistakes in the afternoon. But traders who review learn quickly. Sometimes you'll notice a pattern. Maybe you always get impatient after your first win. Maybe you size up too aggressively after a loss. Catching these patterns midday gives you the power to adjust before the afternoon session. Adjusting the plan. Markets change. What was true in the morning may not be true by the afternoon. That's why professional traders adapt. During your midday reset, ask, has the market tone shifted? Are the levels I marked still valid? Is volume drying up or is it increasing? Do I still have high probability setups left? Or is it better to stop trading today? Sometimes the right move is to step aside completely. Other times, you'll see new opportunities. But the key is this. You're making decisions with a clear head, not from exhaustion or frustration. The hidden benefit, emotional reset. The midday reset isn't just about energy, it's also about emotions. Trading is emotional, even when we pretend it's not. Wins make us overconfident, losses make us reckless. Boredom makes us careless. By stopping at midday, you give yourself a chance to cool those emotions before they control your trades. Think about the last time you had a big win in the morning. How tempting was it to double your size in the afternoon? Or the last time you had a loss? How badly did you want to make it back? Without a reset, those emotions build like steam in a pressure cooker. With a reset, you release the pressure. You calm down. You regain control. Practical midday routine example. Here's a simple midday reset routine you can follow. Close your screens for at least 15-30 minutes. Eat a light balanced meal. Do 5 minutes of breathing or meditation. Move your body. Walk, stretch, or light exercise. Review your morning trades in your journal. Adjust your afternoon plan or decide to stop trading for the day. This whole routine can take just 30-45 minutes, yet it could save you from costly mistakes in the second half of the session. Closing thoughts for Chapter 5. The midday reset is not optional. It's essential. It separates the amateur who burns out from the professional who endures. Remember, trading is not about doing more. It's about doing better. When you rest, recharge, and reassess, you're not wasting time. You're investing in your discipline. You're protecting your capital. You're sharpening your edge. The market will still be there when you come back. But you'll be clearer, calmer, and ready to finish strong. So step away, breathe, reset. Your trading account will thank you. Chapter 6. Closing Routine. The closing bell is near. The charts are slowing down, volume is shifting, the trading day is almost done. This is where many traders make one of two mistakes. They either chase one last trade out of desperation, or they shut everything down without reflection. Both are dangerous. A professional trader knows the closing routine is just as important as the morning preparation. It's the way you wrap up, reset, and prepare for tomorrow. In this chapter, we'll break down the essentials of a strong closing routine. Wrapping up positions before the close. Recording results in your trading journal. So why? Extracting the lessons learned today. Wrapping up positions before the close. If you're an intraday trader, the first question you must ask yourself before the close is simple. Do I hold this position overnight or do I close it? Now, holding overnight isn't automatically bad. Swing traders do it all the time. But intraday traders, those who focus only on the day's action, usually don't. Why? Because overnight risk is real. Anything can happen when the market is closed. News breaks, earnings reports drop, geopolitical events unfold. And when the market reopens, price may gap against you. That gap can wipe out your stop loss and damage your account. Professionals don't gamble with overnight risk unless it's part of their strategy. If you're a day trader, you should make it a habit. Flat by the close. In other words, no positions carried over. This is not just about safety, it's also about psychology. Closing your trades means closing the emotional loops in your head. You don't go to bed worrying, what if? Instead, you sleep with a clear mind, ready for a fresh start tomorrow. If you do hold positions overnight, make sure it's intentional, not accidental. It should be planned, with reduced size, and with stops in place. Never let "I'll just hold and hope" be your strategy. Recording results in a trading journal. Once positions are closed or planned for overnight, it's time for the most powerful part of the closing routine, the journal. Here's a truth most traders ignore. Your trading journal is more valuable than any strategy. The journal is where you transform experience into wisdom. Without it, you're just repeating the same mistakes over and over. With it, you evolve. So what should you record? At minimum, the trade setup, entry, exit, stop, target. The reason you took the trade. Whether you followed your plan. The result, profit, loss, break even. Your emotions during the trade. But don't just log numbers. Log feelings. Did you feel anxious? Overconfident? Did you hesitate? Did you chase? These notes reveal your behavioral patterns, the true drivers of success or failure. Think of your journal as a mirror. It doesn't lie. It shows you what you really did, not what you wish you did. And here's the best part. Over time, patterns emerge. You'll see which setups make you money and which don't. You'll see when you're disciplined and when you're emotional. This feedback is priceless. The act of writing also reinforces discipline. It forces you to face the truth of your actions. And when you face the truth consistently, you grow. Lessons learned today. The final step in your closing routine is reflection. Ask yourself, what did I learn from today? What did I do well? What will I improve tomorrow? It doesn't have to be long, just a few honest notes. For example, I waited patiently for my setup. Good discipline. I overtraded after my first loss. Need to step away next time. My entries were solid, but I moved my stop out of fear. Must trust my plan. This reflection locks in the lesson. It turns a trading day, win or lose, into growth. Remember, every day the market teaches you something. The question is whether you're listening. Why this routine matters. Let's zoom out. Why does the closing routine matter so much? Because trading is not just about making money today. It's about building a long-term career, and careers are built on consistency. Your closing routine is the bridge between today and tomorrow. It ensures you don't carry emotional baggage forward. It ensures you capture insights before they fade. It ensures you go into the next day prepared, not reactive. Think of it like a professional athlete. After a game, they don't just pack up and go home. They review film. They analyze performance. They rehab. They prepare for the next match. Traders must do the same. An example of a simple closing routine. Here's a sample routine you can follow. Close intraday positions unless holding overnight is part of the plan. Update your trading journal with entries, exits, reasons, and emotions. Write down lessons learned in 1 or 2 sentences. Shut down your trading platform and step away. That's it. Simple but powerful. Do this every day, and you'll build a habit of reflection and growth that most traders never develop. Closing thoughts. For Chapter 6. The trading day doesn't end when the market closes. It ends when you close it, with discipline, with reflection, and with intention. So remember, wrap up your positions. Don't leave trades open by accident. Journal your results honestly. Numbers and emotions both matter. Capture the lessons before they fade. Every day has something to teach you. When you follow this routine, each day becomes more than just another trade. It becomes a stepping stone toward mastery. Because success in trading isn't built on one big win. It's built on thousands of small, disciplined routines, day after day, close after close. Chapter 7. Evening reflection. The trading day is done. The screens are off. The markets are closed. For many traders, this is where the day really ends. They walk away and try to forget. But for successful traders, the evening is not just downtime. It's a golden opportunity. A chance to review, to learn, and to prepare. Evening reflection is not about working longer hours. It's about working smarter. Just 30 minutes of structured reflection can separate a struggling trader from a consistent one. In this chapter, we'll break it down into 4 powerful evening habits. 1. Reviewing journal notes and charts. 2. Preparing for tomorrow. 3. Learning from mistakes without self-criticism. 4. Building continuous growth through reading and education. Reviewing journal notes and charts. Earlier in your closing routine, you log trades into your journal. The evening is when you come back to those notes with a calmer mind. Why wait until evening? Because distance gives you perspective. During the trading day, emotions are high. At night, you're more detached and you can see the day with clearer eyes. So take a few minutes to review. Look at your trades on the chart. Were your entries clean? Were your exits logical? Compare your actions against your plan. Did you follow your rules or did emotions creep in? Read your emotional notes. What patterns do you notice? Over time, you'll start to see your own trading personality emerge. Maybe you're great at spotting setups but struggle with exits. Maybe you're disciplined in the morning but sloppy in the afternoon. These patterns are gold. They show you exactly where to improve. Here's the key. Don't just look at numbers. Numbers tell you what happened. Notes tell you why it happened. And it's the why that transforms traders. Preparing for tomorrow. Next, you shift your focus forward. Trading is a game of preparation. Tomorrow's success begins tonight. Here's how professionals prepare in the evening. Review the economic calendar. Are there major events tomorrow? Earnings, Fed announcements, data releases? Mark levels on charts. Identify key support, resistance, or trend lines that could matter tomorrow. Set intentions. Write down 1 or 2 goals for the day ahead. For example, be patient and wait for setups, or take no more than 3 trades. This doesn't need to take hours. 10 to 15 minutes of prep is enough to give you a huge advantage. Think of it like an athlete laying out their gear the night before a big game. When morning comes, there's no rush, no confusion. Everything is ready. You step into the market with clarity, learning from mistakes without self-criticism. Now let's address one of the hardest parts of trading: mistakes. Every trader makes them: wrong entries, missed exits, overtrading, hesitation, revenge trading. The list goes on. The danger isn't the mistake itself, it's the way you respond to it. Most traders beat themselves up. They replay the mistake in their head 100 times. They label themselves stupid, undisciplined, or worse. This kind of self-talk destroys confidence. But professionals take a different approach. They treat mistakes as feedback, not failure. Here's how you can do the same. Route 1. Acknowledge the mistake. Don't ignore it. Write it down. Be honest. 2. Identify the trigger. What caused it? Was it fear, greed, fatigue, overconfidence? 3. Create a solution. What can you do differently next time? Set a rule or a habit to prevent a repeat. 4. Let it go. Once you've extracted the lesson, move on. Don't carry the weight into tomorrow. Think of mistakes like potholes on the road. If you hit one, you don't stop driving forever. You note where it was and steer around it next time. That's how growth works. You're reading continuous education habits. Finally, the evening is a perfect time for growth outside the charts. The best traders are lifelong learners. They read, they study, they sharpen their minds constantly. Markets evolve and traders must evolve with them. This doesn't mean drowning in technical analysis textbooks every night. It means consistent, steady learning. Trading books, psychology, risk management, biographies of great traders, market history. Understanding past cycles and crashes gives perspective. Performance books. Topics like discipline, focus, and habits apply directly to trading. Audiobooks or podcasts. Easy to consume while cooking, walking, or relaxing. Even 15 minutes a night adds up. Over a year, that's more than 90 hours of extra knowledge without overwhelming yourself. But here's the key. Don't just read, apply. Take one idea from a book and test it in your trading. Let knowledge become action. Why evening reflection works. You might wonder, why not just relax and forget about trading at night? Why do this extra step? Because evening reflection builds a loop of growth. The morning routine sets you up. The execution routine tests you. The closing routine records your results. The evening reflection turns those results into lessons and preparation. It's a cycle. Each day builds on the last. Over time, that cycle compounds, just like money in an account. Most traders focus only on setups and strategies, but the traders who thrive focus on process and reflection. That's the real edge. Closing thoughts for Chapter 7. The evening is not just the end of your trading day, it's the foundation for tomorrow. So remember, review your journal and charts with fresh eyes. Prepare for tomorrow's market with clarity and intention. Learn from mistakes, but without self-criticism. Feed your mind with books, podcasts, and continuous learning. And you do this, and every day, win or lose, becomes progress. Because success in trading doesn't come from avoiding mistakes. It comes from learning from them, growing through them, and showing up sharper the next day. And when you reflect each evening with discipline and curiosity, you're no longer just trading. You're building mastery. Chapter 8. Lifestyle Habits of Successful Traders. Most people think trading success comes from secret indicators or insider strategies. But ask any seasoned trader, and they'll tell you, the real foundation is not the charts, not the setups, not even the money. It's the lifestyle. Because trading is demanding. It requires focus, patience, and emotional control. And those don't come from caffeine and adrenaline. They come from how you live when you're not trading. In this chapter, we'll cover 3 pillars of a trader's lifestyle. 1. Sleep schedule and health, fitness, diet, and mindset. 2. Balancing trading with the rest of your life. 3. How routines outside the market build long-term consistency. Sleep schedule health. Let's start with the most underrated trading tool, sleep. Think about it. If you show up to the market exhausted, your brain is foggy, your reaction time slows, your discipline weakens. Suddenly, the setup you would normally wait for feels like close enough, and one sloppy trade can undo days of progress. Sleep is not optional. It's your brain's reset button. Professional traders treat it like part of the job. They go to bed and wake up on schedule, even on weekends. They know consistency in sleep equals consistency in trading. Then there's fitness. You don't need to be a bodybuilder, but movement matters. Exercise sharpens focus, reduces stress, and gives you stamina for long trading sessions. Even a daily 30-minute walk or a short workout at home can make a difference. And let's not forget diet. What you eat is fuel. Heavy, greasy meals make you sluggish. Constant sugar spikes crash your focus. Balanced meals, protein, vegetables, whole grains keep your energy steady. Finally, the mindset. Health isn't just physical, it's mental. A strong trading mindset comes from habits like meditation, journaling, or mindfulness. Just 5 minutes a day can calm your thoughts and strengthen discipline. Think of it this way, your body and mind are the hardware. Trading is the software. If the hardware is weak, the software can't run. Balancing trading with life. Now let's talk about something most traders ignore until it's too late. Balance. Trading can consume you. The charts call your name. The numbers flash. The temptation to check just one more time is constant. And before you know it, trading isn't just your job or hobby, it's your entire identity. That's dangerous, because when trading becomes your whole life, every win feels like proof of your worth, and every loss feels like failure as a person. That emotional weight is too heavy. Successful traders keep balance. They have hobbies. They spend time with family and friends. They read, travel, or play sports. They live outside the charts. Why? Because balance creates resilience. If trading is all you have, every losing day feels like the end of the world. But if trading is just part of a full life, losses don't break you. They're just one piece of the bigger picture. Here's a simple test. If the market closed tomorrow for a month, would you still know who you are and what to do with your time? If the answer is no, then it's time to build balance. How routines build long-term consistency. We've been talking about routines all throughout this book. Morning routines, execution routines, evening routines. But your life routines, the habits you live by day after day, are what hold it all together. Consistency in life creates consistency in trading. Think about it. A consistent sleep schedule means you're alert every morning. A consistent exercise habit means you handle stress better. A consistent journaling habit means you're always learning. Or more, a consistent social life means you don't drown emotionally in trading. It's not about perfection. Nobody eats clean every day or wakes up on time every single morning. But it's about the trend, the direction. Just like trading, it's not one trade that matters. It's the series of trades. In life, it's not one choice that matters. It's the series of choices. And here's the truth. Routines compound. Just like money compounds interest, habits compound results. One good day leads to another. One strong week leads to a stronger month. Over years, these small habits build a trader who is calm, focused, and resilient. A day in balance. Example. To bring this to life, let's imagine the daily routine of a successful trader, not just at the charts, but in life. 6:30 a.m. Wake up at the same time every day, refreshed from 7-8 hours of sleep. 7 a.m. Light exercise or stretching, followed by a healthy breakfast. 8 a.m. Market preparation, news review, journaling goals. 9:30 a.m., 12 p.m., focused trading session. 12 p.m., midday reset, walk, lunch, short meditation. 1 p.m., 4 p.m., afternoon trading if needed, or market study. 4 p.m., closing routine and journaling. Evening, time with family, reading, hobbies, or light study. 10:30 p.m., wind down, no screens, no stress, sleep. Notice something? Trading is just part of the day, not the whole day. That's balance, that's health, that's sustainability. Closing thoughts for Chapter 8. Here's the truth. Trading success is not built in the heat of the moment. It's built in the quiet hours, in the routines, in the way you live when nobody is watching. Your sleep, your diet, your exercise, your balance, your routines. These are not extras. They are the foundation. Without them, discipline crumbles. With them, discipline becomes second nature. So remember, protect your sleep like it's part of your trading strategy, because it is. Move your body and fuel it well. A strong body supports a sharp mind. Keep trading in balance with life. Don't let it consume you. Build routines that last, because consistency in life leads to consistency in trading. Success in the markets is not about doing more. It's about living better. And when your life supports your trading will support your life. Chapter 9. Weekly, monthly routines. Trading is not just about what happens today. It's about what happens over weeks, months, and years. A single day can be lucky. A single trade can be random. But when you zoom out, when you look at weeks and months, you see the truth. You see patterns. You see habits. You see whether you're improving or stuck. That's why weekly and monthly routines are essential. They turn your trading from a chaotic activity into a structured, professional practice. In this chapter, we'll cover 3 core parts. 1. Weekly review sessions. 2. Monthly performance tracking. 3. Adjusting strategies based on results. Weekly review sessions. Every week you should hit the pause button, step back from the charts, step back from the noise, and ask, what actually happened this week? The weekly review is not about judgment, it's about clarity. Here's how to do it. 1. Collect your data. Look at all your trades from the week, wins, losses, break-evens. Don't just glance at them, organize them. Write them down, or better, keep them in a spreadsheet or trading journal app. 2. Look for patterns. Ask yourself, what setups work best? Which trades followed my plan and which ignored it? Did I stick to my risk management rules? Did emotions play a role? Fear, greed, impatience? This is where the truth comes out. Maybe you'll see that most of your wins came in the morning, but your afternoon trades were sloppy. Maybe you'll notice that the trades you forced without a clear signal were almost always losers. Yes. 3. Score yourself. Give yourself a grade, not just on profit and loss, but on discipline. Did you follow your plan? Did you manage risk? Did you overtrade? A trader who loses money but sticks to their rules can still call the week a success, because discipline today leads to profits tomorrow. Word 4. Summarize in a journal. At the end of your weekly review, write a short summary. A few sentences is enough. Something like, this week I was disciplined in the mornings but got impatient in the afternoons. Next week I'll limit myself to 2 afternoon trades maximum. That's it. Simple, clear, actionable. Monthly performance tracking. If the weekly review is about details, the monthly review is about the big picture. At the end of the month, zoom out even further. Look at all 4 weeks together. Patterns that were invisible day to day or week to week often become obvious at the monthly level. Here's how to approach it. 1. Check the numbers. Total profit or loss, win rate, risk to reward ratio. Average gain per trade versus average loss per trade. These numbers don't lie. They tell you if your edge is real or if you're just spinning your wheels. 2. Identify strengths. Maybe your best trades are breakouts. Maybe you're strongest in trending markets. Maybe you're great at managing winners, but struggle to cut losers. Whatever it is, find it. Your strengths are the seeds of your edge. 3. Identify weaknesses. This part hurts, but it's where growth happens. Maybe you're still overtrading. Maybe your position sizing is inconsistent. Maybe you hold losers too long, hoping they'll turn around. Be honest with yourself. 4. Evaluate discipline versus results. This is key. Sometimes you can be disciplined and still lose money. That doesn't mean you failed. It just means the market was choppy or your strategy had a cold streak. Other times you might make money while breaking your rules, and that's dangerous. Never confuse luck with skill. 5. Write a monthly reflection. End with a written reflection. Think of it as a letter to yourself. Summarize what went well, what went wrong, and what you'll improve next month. Example: this month I made steady gains in the first 2 weeks, but I lost focus in the third. My biggest losses came from not respecting my stop loss. Next month, I'll set hard stops before every trade, no exceptions. That reflection becomes your compass. Adjusting strategies based on results. Now we come to the most powerful part of weekly and monthly routines. Adjusting. Markets change. What worked last month may not work this month. A successful trader doesn't stubbornly repeat the same mistakes. They adapt. Here's how to do it. 1. Don't change everything. If something is working, keep it. Don't throw away your edge just because of a few losses. Small adjustments are better than big overhauls. 2. Tweak, don't reinvent. Let's say your review shows you're losing money in afternoon trades. The solution isn't to quit trading altogether. The solution is to limit your afternoon trades or avoid them unless the setup is perfect. 3. Test new ideas carefully. When you notice a weakness, you may want to test a new rule or strategy. That's fine, but test it small. Don't risk big money on unproven ideas. Trade them in simulation or with minimal size until you see results. 4. Stay consistent in process. Even if your strategy evolves, your process should stay consistent. Always review weekly. Always track monthly. Always learn from results. That process is your anchor. Why this matters. Here's the truth. Most traders never review. They just trade without stopping to ask what's working and what's not. That's like trying to drive across the country without checking the map. Weekly and monthly routines are your map. They keep you from drifting. They keep you accountable. They show you the road ahead. And most importantly, they turn you into a professional. Because amateurs react, professionals reflect. Amateurs chase, professionals adjust. Our goal. Closing thoughts for Chapter 9. Let's recap. Weekly reviews give you short-term clarity. You see your habits and patterns from the past 5 days. Monthly reviews give you long-term vision. You zoom out, track your numbers, and evaluate discipline versus results. Adjustments keep you flexible. You learn, adapt, and refine your edge without losing discipline. This is the rhythm of a successful trader's life. Daily discipline, weekly review, monthly reflection, and steady adjustment. It's not glamorous, it's not exciting, but it's powerful. Because success in trading is not about predicting the future. It's about preparing for it. And when you build these routines week after week, month after month, you stop guessing and you start growing. Chapter 10. Putting it all together. We've covered a lot of ground in this book, from mindset to pre-market prep, from execution to evening reflection, from lifestyle habits to weekly and monthly reviews. But here's the truth. Knowledge without action is useless. So in this final chapter, we're going to put everything together into one clear, structured, repeatable daily routine. Then we'll go even further. I'll give you a simple checklist you can follow every single day, and finally, I'll show you how to turn these routines into part of your identity as a trader. Because once something becomes part of who you are, it stops being effort. It becomes automatic. Example, a full trader's daily routine. Let's walk through a day in the life of a successful trader. This is just an example. You'll adjust it to your own style, market, and schedule, but it gives you a model to follow. 6:30 a.m., wake up and prepare the mind. The trader wakes up early, after 7-8 hours of sleep. No rushing, no hitting snooze. A few minutes of stretching or light exercise. A glass of water, maybe meditation or journaling. The goal is to start calm, focused, and present. 7 a.m. news and market prep. The trader reviews overnight news, the economic calendar, and major global events. They check futures or pre-market movement to see the market's mood. Then they begin scanning charts, marking key support and resistance, identifying possible setups. 8:30 a.m. daily trade plan. The trader writes down a simple plan. What setups they're looking for. What levels matter most? How much risk they'll allow today. This plan goes into the journal, clear and written, not floating in the mind. 9:30 a.m. Market open in execution. Now it's game time. But the trader isn't rushing. They wait for their setups. They enter only when their rules align. Each trade has a stop loss and target set in advance. They don't chase. They don't force. They follow the plan. 11:30. Midday reset. After the first 2 hours, the trader steps back. Win or lose, they take a break, lunch, exercise, maybe meditation again. They let the brain reset. 1 p.m. afternoon session. If the market offers quality setups, the trader takes them. If not, they sit out. They know sitting on their hands is as much a skill as pulling the trigger. 3:30 p.m. closing routine. The trader starts wrapping up. They exit positions if they're intraday focused. They record all trades in the journal, entries, exits, emotions, notes. The goal isn't just to log numbers, but to learn from them. 5 p.m. evening reflection. Later in the evening, the trader reviews the day. They reread their journal. What went well? What could improve? They prepare for tomorrow, marking charts, writing goals, and reflecting. 10:30 p.m. wind down. No charts, no screens. The trader disconnects, reads, relaxes, or spends time with family. Then, consistent sleep, because tomorrow is another day. That's the daily routine. It looks simple, even boring. But that's the point. Success in trading is not about drama. It's about structure. Checklist. Template, the daily routine. Here's a checklist you can use. Read it each day until it becomes automatic. Morning, 7-8 hours of sleep completed. Exercise, meditation, or journaling done. Review overnight news and economic calendar. Mark key support/resistance on charts. Write daily trading goals. During trading, only enter trades that fit the plan. Set stop loss and target before entering. Avoid overtrading, quality over quantity. Take breaks when needed. Closing routine. Exit intraday positions. Record trades in journal. Entries, exits, emotions. Write lessons learned. Evening. Review journal and charts. Prepare tomorrow's plan. Disconnect from screens and recharge. Use this checklist as your accountability partner. At first it will feel like work, but soon it will feel natural. Wonder, motivation. Turning routines into identity. Now here's the real secret. Routines are powerful, but only when they become part of your identity. Think about it. A person who tries to go to the gym struggles. But a person who identifies as an athlete doesn't debate whether to exercise. It's just who they are. The same applies to trading. If you think of yourself as someone who tries to follow a routine, you'll constantly fight with yourself. But if you see yourself as a disciplined trader, then the routine is not a choice. It's your nature. How do you make that shift? By repeating, by showing up, by doing the routine even on days you don't feel like it. Every time you follow your process, you cast a vote for your new identity. One day you'll realize it's not just what you do, it's who you are. This is how the best traders are made. Not from one big breakthrough, not from one massive win, but from small repeated actions, routines that shape them into consistent professionals. Closing thoughts for the book. So here we are. You now hold the blueprint for a successful trader's daily routine. You've seen how mindset, preparation, execution, reflection, lifestyle, and reviews all connect. You've seen how structure leads to freedom. Remember this, trading success is not about luck. It's not about magic strategies. It's not about predicting the market. It's about discipline. It's about consistency. It's about routines that become identity. So tomorrow morning, when you wake up, ask yourself, what does a successful trader do today? And then do it. Because over time, those daily actions will add up. They'll shape your habits. Your habits will shape your identity. And your identity will shape your success. This is not just a trading routine. It's a way of life. And if you live it, you will not just trade successfully, you will become a successful trader. Conclusion, success is not luck, but habit. If you've made it this far, you already understand something that most traders never do. Success in trading is not random. It's not luck. It's not a lottery ticket. Success is habit. It's the daily actions you take, the routines you build, the discipline you enforce, even when nobody is watching. Throughout this book, we've walked through the entire rhythm of a trader's life, from the morning mindset to the pre-market routine, from executing trades with discipline to stepping away when needed, from closing the day with reflection to reviewing weekly and monthly results, and finally, from building a balanced lifestyle to making routines part of your very identity. When you step back and look at the whole picture, you see the truth. Trading isn't about big wins. It's about small wins, repeated over time. Success is not luck. Think about the traders who fail. They rely on luck. They hope the market will save them. They jump in without a plan. They let fear and greed drive their choices. Sometimes luck does favor them. They catch a big win. They feel invincible. But luck is a cruel teacher. It always runs out. And when it does, their accounts vanish. Now think about the traders who succeed. They don't rely on luck. They don't care about being right all the time. They care about being consistent. They care about managing risk. They care about showing up every day with discipline. Their success doesn't come overnight. It comes gradually, like a tree growing from a seed. Small, steady actions, day after day. Until one day, what looked like luck from the outside is actually years of habit on the inside. That's the trader you want to become. The power of habit. Habits are the invisible force shaping your trading. Wake up late, skip preparation, chase trades, ignore stops. Those are habits, and they build the habit of losing. Wake up early, review the market, plan trades, follow rules, reflect in a journal. Those are habits too, and they build the habit of winning. It's that simple. The market doesn't reward what you want. It rewards what you do. And what you do consistently is what defines you. So stop chasing the perfect strategy. Stop searching for the Holy Grail. The real Holy Grail is discipline. The real edge is routine. The real secret is habit. Final words of encouragement. Right now, you might feel overwhelmed. You might think, this is a lot. Can I really follow all these routines? Here's the truth. You don't need to be perfect. You just need to start. Don't try to master everything in one day. Pick one habit. Maybe it's journaling your trades. Maybe it's setting a consistent wake-up time. Maybe it's reviewing your week every Sunday. Start small. Do it daily. Build momentum. Over time, one habit will lead to another. Just like compound interest grows wealth, compound habits grow discipline. Before long, you'll look back and realize you've become the kind of trader you once admired. And remember this. Every trader you look up to was once where you are now. They struggled. They doubted. They made mistakes. The difference is they kept going. They built habits. They turned those habits into routines. And those routines turned into success. So don't stop. Your next step. When you wake up tomorrow, don't ask, will I be lucky today? Ask, what would a successful trader do today? Then do it. Because every time you follow your process, you're not just trading. You're shaping your future. You're proving to yourself that you have what it takes. This book isn't the end of your journey. It's the beginning. The habits you start today will carry you through weeks, months, years of growth. A final thought. Trading is not about conquering the market. It's about conquering yourself, your fear, your greed, your impatience. And the weapon you use to conquer them is routine. So commit, build your habits, live your routines. Because success is not luck. It's not a secret formula. It's not a gift from the market gods. Success is simply this, the daily choice to act like the trader you want to become until you are that trader. So go, build your habits, live your routines, write your story. And remember, the market rewards discipline, always.